What are natural gas futures options? Have you ever wondered how traders manage the ups and downs of natural gas prices? Natural gas futures options are a key tool in this process. These financial contracts give the buyer the right, but not the obligation, to buy or sell a natural gas futures contract at a specific price before a certain expiration date. This flexibility makes them appealing to many traders. To grasp natural gas futures options, it is essential to first understand natural gas futures. A natural gas futures contract requires the buyer to purchase and the seller to deliver a fixed volume of natural gas at a predetermined price on a future date. These contracts are typically settled either physically or financially. They are traded on regulated exchanges like the New York Mercantile Exchange or the Intercontinental Exchange. This market allows producers, consumers, and traders to hedge against price fluctuations or speculate on price movements. Now, let's talk about the added layer of flexibility that natural gas futures options provide. Instead of being locked into buying or selling natural gas, the holder of an option can choose whether to exercise it. If they decide not to, the option can simply expire worthless. There are two main types of options. Call options give the buyer the right to purchase a natural gas futures contract at a specified price, known as the strike price. On the other hand, put options give the buyer the right to sell a natural gas futures contract at the strike price. Understanding the strike price is vital. It is the predetermined price at which the futures contract can be bought or sold if the option is exercised. From a trading perspective, natural gas futures options operate similarly to options on stocks, but they are tied to a commodity futures contract. Traders use these options for hedging risks or for speculative strategies. For instance, a natural gas producer might buy put options to protect against falling prices. Meanwhile, a trader who believes prices will rise might purchase call options to gain exposure with limited risk. Key points to remember about natural gas futures options include that they provide the right, not the obligation, to enter into a natural gas futures contract. They allow market participants to manage their exposure to the volatile natural gas market without fully committing to futures contracts. These options are traded on regulated futures exchanges through registered futures brokers. The pricing of these options depends on various factors, including the current price of natural gas futures, the time remaining until expiration, market volatility, and the strike price. Natural gas futures options can be used in different strategies, such as hedging physical natural gas exposure or speculating on price movements with defined risk. In essence, natural gas futures options are derivative contracts that offer the right to buy or sell natural gas futures at a set price before expiration. They combine the characteristics of options trading with the underlying natural gas futures market, providing traders with tools to manage price risk or pursue profit opportunities in the energy sector.